Hello, I'm Soleil. I'm an angel investor and venture capital investor based in Sydney. Today, I'm going to be sharing about the mechanics involved in converting a SAFE, also known as a simple agreement for future equity. Let's first start with some definitions. A SAFE, it's a contract where an investor provides the cash now in exchange for equity in a future price round or if there is an exit. This type of contract started about a decade ago in 2013 by Y Combinator, a now San Francisco based accelerator. The SAFE, it's widely accepted worldwide and it has developed a simpler alternative known as a convertible note, which is a loan that converts to equity at a later date. What's important to note is that the future priced round determines the price of shares issued, and this is determined by a valuation cap, or you might hear this as val cap. So, for example, $5 million is the val cap. This is the maximum price at which an investor converts their SAFE to equity. In essence, it's protecting the investor if the valuation of the company jumps up by a lot. The other aspect that may determine the price is the discount rate. So, for example, it could be between 15 to 25%. And this allows the investor to buy shares at a reduced price versus new investors in the priced round. So there's a lot here to take note, but we are going to step through an example to show how this works in practice. But there are still a few things to go through. Here are some elements about a SAFE to take note of. Essentially, it's designed to reward the early risk that investors take to help grow a startup in the early stages. It's typically described as founder friendly and it's fast to close. And this is because there are a reduced number of documents, legal documents, especially compared to a priced round. It's a more common investment instrument at the pre-seed and the seed stage, especially when it may be a bit too early or too expensive to run a full priced equity round. Unlike a fully priced round, you don't have to sign everything at the same time. You enter into a SAFE with each investor. That is, they're separate transactions. But you may want to have a time frame to complete this so you can continue to focus on building your growing business. And because they are separate transactions, you can even issue multiple SAFEs, each with their own terms, and you can do this over time as well. And they can all convert at the next price round. That is, they are stackable. But it's very important to note to be very careful and understand the implication to your dilution from this concept of SAFE stacking. So let's briefly touch on the theory of how a SAFE converts before we put it into practice with some numbers. So you've executed a SAFE and now we are in the future and there is either a priced equity round or there's going to be an exit event such as an acquisition or an IPO. Starting with the priced equity round, we have two scenarios. That is, whether the valuation of the priced round is below or above the valuation cap of the SAFE. So if the post-money valuation of the priced equity round, we'll say $10 million, is greater than the valuation cap of the SAFE at $5 million, then it converts into a priced round shares at the SAFE val cap. So remember, this is to reward the investor for taking on that risk at the earlier stage. But if the valuation of the price round is only $2.5 million, this is less than the val cap of the SAFE of $5 million. And so it converts into priced round shares at a discount to the priced round. So again, the investor receives a benefit for taking on the risk at the earlier stage, but it just depends on where the valuation is and where the safe val cap is to determine which basis you do it on. Now, if there's an exit event, either via acquisition or IPO, which is initial public offering, then the purchase amount is either returned or they convert to shares at a safe val cap. But for these, the mechanics of what it is, often it depends on what the details are in various contracts. So here's the theory at a very high level. Let's take it one step further with looking at some numbers in practice. This may look a little familiar. I've gone through a previous video of how dilution works with a simple priced round. If you haven't watched that and aren't familiar with simple priced rounds, then I highly recommend that you go and watch that first and then return to this video. So we are going to be converting a post-money safe in this example. This is generally now market standard both in Australia and in the US, and likely in many other countries around the world as well. There's more ownership certainty because it's fixed as a percentage of the post-money cap. So that's why this instrument, this particular way, is much more preferred in documents. So in this example, we are assuming there are two equal founders and there is an employee share option pool. They've raised a safe a little while ago of $1 million with a post-val cap of $5 million and a discount of 25%. And they're about to close their Series A. They've done really well and they have raised $5 million on a pre-money of $20 million. So we are going to run through the calculations, both the cap, the val cap, and also the discount mechanics with these numbers. And to make it a little bit more simple, we are not going to add any additional employee share options here. So let's start with the val cap. We want to work out the share price of the Series A taking into account the safe first. So let's first calculate the value of the note, which is the safe amount of $1 million divided by the post-money val cap of $5 million. And then we are going to multiply this by the Series A pre-money of $20 million. So this is worth $4 million. Next, we're going to work out the effective pre-money valuation, having taken the safe into account. So this is the Series A pre-money minus the effective value of the note of $4 million to get you the $16 million. So from the simple priced equity round video that I've shared before, you'll remember to find out the share price before new money comes in, we look at the pre-money val and divide it by the total number of shares. So in this case, we're taking the effective pre-money valuation of $16 million because we need to take into account the note. And then we've got the founders and the ESOP, and that's 2,400 shares. It gets you the share price of 6,667. So I just want to make a note here. So remember, we have received the $1 million from these safe investors previously, but because a safe is for a promise for future equity, they haven't been added to the cap table yet until they convert. And so this is what we're doing in this example. So we can now calculate the share price for Series A investors. $5 million at the Series A divided by the share price of 6,667 gets us 750 shares. Now we're going to figure out the price of the shares of the note holders of the safe, as well as the number of shares and therefore their equity percentage as well. So their share price is the share price we calculated before of 6,667, but we need to make an adjustment for the post-money val cap of $5 million. And we do this by dividing it by the Series A pre-money val of 20 mil. And this gives us a share price of 1,667. So we can now determine how many shares they get at their share price of 1,667, which is the $1 million they've invested divided by the note share price, and they have 600 shares. So flowing on from that, we can work out the equity. So although they invested $1 million, the amount of equity of that business is at the effective value of the note we calculated initially of $4 million. Now, after the Series A, the company is going to be worth $25 million on a post-money basis. So plugging in these numbers, the note holders effectively have 16% of equity. So these are all the calcs of converting a safe at the val cap. We're now going to do this on a discount basis. So again, we're going to calculate the value of the note at the Series A, but taking into account the discount rate this time. So in this case, it's the safe amount of $1 million, and we're going to divide that by 1 minus the safe discount rate of 25%, which gives us a figure of, we'll call it 1.3 mil. The pre-money valuation, taking into account the safe, is the Series A pre-money val less the effective value of the note of 1.3 mil, giving us a figure of, again, we'll call it 18.7 mil. So again, to calculate the share price, we now have the effective pre-money valuation, and we're going to divide it by the total number of shares, which is 2,400, to give us a share price of $7,778. Now we can calculate the number of Series A shares, which is 5 million divided by the $7,778 share price to get us 643 shares. So we're continuing to step through. We're going to calculate the share price of the notes. It's the share price, but 1 minus the safe discount. So the 7,778 multiplied by essentially 75% to get us a figure of 5,833. And the number of shares is the $1 million of the safe amount that they've invested before, divided by this share price of 5,833 to get us 171 shares. So the effective value of the note, we initially calculated of $1.3 million. We're going to divide this by the post-money valuation of the $25 million, which means that the note holders of the safe have an equity position of 5.33% if we're using the discount basis. So that's a very brief way of how to convert a post-money safe, both on a val cap basis and also a discount basis. So now looking at the equity proportion of the safe, on a val cap basis in this example, they have 16%, and on a discount basis, they have 5.33%. But the calculations we convert the post-money safe on is going to be the val cap basis. And this is because the post-money valuation of the Series A of 25 mil is higher than the val cap of the safe of $5 million, like we showed very early on in the theory slide. But it's always good to do both the calcs just to double check. So let's now look at the cap table after converting the safe. We have our initial cap table, and then we also have the calculations of the safe and the Series A that we calculated using the val cap basis. Essentially, we're going to plug in the figures into the cap table. So for the note holders, they have 600 shares, but remember, they've already invested their $1 million some time ago. And then for the Series A investors, they have invested 750 shares, at a share price of $6,667, making a total investment of the Series A of $5 million. So, taking it now one step further, we're going to look at the converted cap table, but now we're going to also calculate the equity percentage. So, you can see that the Series A investors have 20% of the company, the note holders have 16%, and it's the founders and the employee share option pool in this example that have been diluted by both the conversion of the SAFE as well as the Series A priced equity round. This is why it's really example to understand the implications of a SAFE, because ultimately the founders are diluted, especially in this situation. I know that it's a lot, so let's briefly look at the pros and cons of why you would look at a price round versus a SAFE. So the pros of a price round is that there is certainty. You know the valuation and also the ownership percentage upfront. There can also be some tax incentives, especially in Australia, with regards to being categorized as an ESIC, which is an early stage innovation company. On the con side, at a high level, a price round does take more time, and that's because there are more complex legal docs. And as a result, it can be more expensive, but it should definitely not be the reason that you do not do a priced round. For a SAFE, it can be faster and cheaper to execute, and they can be helpful when valuations aren't exactly clear, especially at the very early stages of a company. But on the con side, it can create cap table complexity, especially if there is any SAFE stacking. And for investors, there isn't any immediate equity and they may not qualify for the ESIC tax incentive as well. So at a high level, here are the pros and cons of a priced round versus a SAFE round. But let's look at some other things to note about a SAFE. There's no right or wrong approach in deciding between a SAFE or a priced round. This presentation, in which I've shared some theory and examples, we've focused on the post-money SAFE, but there are pre-money SAFE agreements out there and the calculations are different. But like I said, in Australia and the US, the market standard is generally a post-money SAFE. There are many online calculators out there, but use them with caution and make sure they are aligned with the terms outlined in your documentation of your SAFE. And make sure all your stakeholders are on the same page regarding the calculations. You do not want a situation where your accounting and your legal advice have different calculations compared to you or your incumbent investors or any future investors. This is really complicated, but there are documentation templates out there which you can access. And one example is the Australian Investment Council. And I'll put a link in the notes below for this. I know this was a long, complex topic, but at a high level of converting a SAFE, and what it looks like on a post-money basis, let me know if there are any other topics you'd love to learn more about.